The latest GF data insights from Q3 2025 are out, but what does the data reveal? Back to talk about the numbers are Forvis, Mazars, Scott, Linch, and GF Data's Bob Dunn. Scott and Bob, welcome back.
Thank you.
Thanks, Carolyn.
Okay, let's start with the broad strokes here. What are some of the trends that continued in the quarter and which showed signs of change?
Yeah, so I think that third quarter is always an interesting quarter coming out of the summer. The deal activity oftentimes is a little slower in that quarter, and I think we saw that here as well as far as number of transactions. We did see some interesting things happen. I think that, there were some large take privates that happened with Thoma Bravo doing some of the largest ones I know, and we did see some of that kind of activity, but we're still seeing some sectors very, very hot. Industrial business services, we're still seeing a lot of activity there. And the public markets have been really nice, I think, and which is leading people to think now is the time to sell some of our platform companies. And so we have seen a lot of movement around. Some funds have sold a decent amount of platforms this year, which has been a change. A lot of these funds are trying to raise money, and only way to do that is if they have some nice exits. And so we are seeing that activity pick up. And with the interest rates having a couple tick downs with potential more, I think there's opportunities to get a different kind of financing that allow for those types of deals to happen.
Yeah, I would chime in. We definitely saw, the cyclicality you normally see in the third quarter for the deals tracked. The overall deal volume was down about 20% compared to the second quarter, about in line with what we've seen historically with the third quarter. On the positive side, we saw valuations increase by a little bit more than half a turn overall on it. Most of that coming from the greater than 50 total enterprise value line, I guess, in terms of the size of companies that we track. Valuations increased on it, deal volume down on it. I agree with Scott. Business services continues to be hot on it. And, we don't directly track the exit side, but I have heard anecdotally that there's a lot more exit activity occurring right now, which is definitely a positive sign. And as Scott notes, it's a big boon when you're out trying to raise money to be able to return some capital to LPs at the same time you're asking for more.
Now, a reoccurring theme that we've brought up several times on these talks in the last few quarters has been above average financial performers, and the trend that the deals that are getting done in a tough M&A environment are those that involve those A-plus assets. So what did the third quarter reveal about these above average financial performers? Bob, let's start with you.
Yeah, it was a bit of a surprise on it. We see a lower composition of above average financial performers. And just to give the definition for everyone out there, we classify above average financial performers as at least having 10% trailing 12-month EBITDA margin and 10% trailing 12-month revenue growth. And it needs to be both of those metrics, not one or the other on it. Traditionally, it's been about 50% of the market that has fallen into the above average financial performance. Through the first 3 quarters of this year, we're down at 44%, so about a 9 percentage point difference on it. So there are fewer of those companies out there getting deals done that we've seen in past years on it. The bigger point on it, though, is the delta between the averages for those AFP companies and the ones that are below that average fell to just 2% for the first 3 quarters of this year. That's the lowest we've ever tracked on it. A couple factors impacting that. We're still seeing elevated levels of add-on activity, and a lot of the add-on deals that we track don't fall into that above average financial performance category. So there's been competition there. You've seen valuations move up with those for those add-on companies. That's pushed the bottom part of it up a bit. And then the top line on it, when you actually go in and look line by line at the financial performance, it's definitely eroded over the last 12 months compared to what we saw 24 months ago on it, particularly with regard to revenue growth. And I think where we are seeing companies that meet the metric for that revenue growth, it's lower than it has been in the past. And then I think there's a number of companies being pulled out of that category just because they had negative revenue growth or below that 10% mark on it.
Yeah, definitely a little surprising to me, the data. I'm gonna go ahead and call this a data glitch quarter, because normally you're gonna see the above average performers getting a higher multiple. And we're hearing some really interesting stories out there about some of these hot assets and how many different IOIs and LOIs they're getting on good businesses. So the competition for good businesses right now is probably at an all-time high. So I think that data is probably going to change when we see fourth quarter data and some of those the deals that are in process get done. We're going to see that pop back up, I think, in Bob's data.
Yeah, and I would agree with it. Again, it's the lowest we've ever seen on it. And I think a statistical glitch is probably a pretty good description on it, because it does seem like there are a lot of interesting companies with very strong performance that are out there. And as Scott notes, the A assets are always going to get A pricing on it. So I think it's a matter of giving a little more time for them to complete their deals, get into the database, and you'll see that delta move up in terms of the premium on the above average versus everyone else.
It is interesting on the revenue growth piece that you talked about, because everyone's managing through situations like tariffs, especially impacting their revenue. And so it actually is creating the revenue growth because of pricing only, not real revenue growth. And so that is something that we're seeing people looking at, right? They're doing heavy price volume type analysis because they want to see that the business is growing based on the volumes, not the price, because the price is often just tariff-related pricing increases, which isn't really driving value in the business itself.
Got it. Okay. Well, tariffs are, of course, a huge topic of conversation in the M&A community right now, but so are interest rate cuts and the massive growth of private credit. So let's wrap up our conversation today with lending trends. What does the Q3 data tell us about credit conditions and what that means for leveraged buyouts and deal structures? Bob?
Yeah, we saw some erosion in terms of senior debt coverage on smaller platform deals. And I think, again, Scott alluded to tariffs. There's definitely risk out there in the broader marketplace outside of tariffs as well. Consumer is relatively stressed right now. I just saw a headline, auto delinquencies are rising at a pretty rapid pace right now. I think there's other concerns about the economy that perhaps impacting some of the coverage levels that we're seeing, at least on the commercial bank side. But as Scott alludes to, you got a lot of debt funds out there, and you got a lot more options for financing out there. We did find that cost of capital for senior debt went up, not a great deal, just a little under a percentage point on it. But it was a surprise to me, again, where the Fed is cutting interest rates. But if you look at it, if you're comparing bank lenders to non-bank and debt funds on it, you're generally going to pay a little bit more of a premium there for a little more accommodating service in terms of fewer covenants and that sort of thing on it. So bit of a surprise that we saw an increase there, but I guess, again, if the composition is moving more toward debt funds, you're probably going to see costs go up a little bit as well.
Yeah, I'd say, I was just talking to one of the large private credit lenders in the space and the middle market, and the comment was it's really gotten super wild out right now, is that people are getting aggressive on what they're trying to do to get into some of these the quality deals that we talked about earlier. And also, the funds that have done well through this kind of a little bit of a trying time, if you're able to lend into those deals, those are really high quality opportunities that people are looking for. And so I think that the private credit markets are providing a lot of options right now.
Yeah, and I'd note we saw a higher percentage, particularly some larger deals of leverage recaps and refinancings going on last quarter. So that kind of plays into, I think, the trend that Scott's talking about as well.
All right. Well, Bob and Scott, thank you again so much for joining us, and we will catch up with you both next quarter.
Great. Thank you.
Always a pleasure. Thanks, Carolyn.